The top stories live from the Sky News City studio. The Bank of England set to raise interest rates for the 12th consecutive time as it battles to curb inflation. The end of the line for First Group as it loses the TransPennine Express contract. I'll be speaking to the Chief Executive of Grainger Group, the UK's largest listed residential landlord. Plus, plans to take British basketball global ahead of this weekend's playoff finals. Good morning, this is Ian King Live in our business and economic news from the heart of the city. Well, the Bank of England's Monetary Policy Committee is widely expected to raise interest rates again today for the 12th consecutive time. The MPC is expected to raise bank rate from 4.25% to 4.5% at noon today. Well, that would take the bank's main policy rate to its highest level since October 2008 and would emulate similar moves last week by the US Federal Reserve and the European Central Bank. Another hike in bank rate became nailed on in the eyes of most market participants when the headline rate of inflation came in at 10.1% for March, well above the 9.2% that the bank itself was predicting in February and confirming the UK as having the highest rate of inflation in the G7. Well, joining me now is the Head of Economics at HSBC UK Commercial Banking, Liz Martins. Liz, welcome to you. Any doubt in your mind that's what we're going to get today?
No, not much doubt, really. As you said, I think, the Bank of England might have liked to pause and stop raising interest rates. But when that inflation number came in considerably higher than expectations, and also the wage number the day before had also been extremely high relative to expectations, when those two pieces of data came through, it really nailed on the decision to hike again. And, they have already moved down from raising by half a point to raising by a quarter. As you said, the Fed and the ECB did the same thing. So it seems highly likely they'll do that. I suppose the uncertainty is who's voting for what. Will anyone vote for a larger move or a smaller move? That's the bit that might be of more interest today.
Well, quite so. I mean, it's possible we might even get a three-way split on the MPC today.
Yeah, definitely. So we know that two members of the MPC already think rates have risen further than they need to. Silvana Tenreira and Swati Dhingra, they've been voting for the last few meetings to leave rates on hold. So they probably do that again. Then you might get some members of the committee who say, hold on, that March inflation number really worried me. Inflation is not going away. We need to act forcefully again and go back up to voting for a half a point move. Base case is no, we've just got the two-way split, but totally possible.
And what about the commentary? I mean, obviously, the Fed and the European Central Bank have hinted over the last week that they may put further hikes on pause for now. I mean, the Bank of England doesn't really have that luxury, does it?
No, I think they'd like to have the luxury, but as you say, the inflation outlook currently is not conducive to pausing, and their credibility is at risk as well. To stop raising rates when inflation is in double digits would be questionable, I think. So I think they're going to keep the wording they had last time. So essentially, they said, look, we're watching the indicators, watching the labour market, we're watching core inflation, and we will raise rates again if we need to. So the guidance is kind of indicating a bias towards tightening or raising rates. It's not committing to that, but it is saying the bias is in that direction. And I think they'll keep that exact wording in the statement today.
Liz, one thing I get asked an awful lot by viewers and readers, let me try this one on you for size, is why have the bank's interest rate rises to date failed to rein in inflation?
Well, I think, rate rises operate with a lag, don't they? And that's the really difficult part of this conundrum for the Bank of England. I think the received wisdom is that it takes kind of 18 months to 2 years for a rate rise to have its full effect. So for those members who don't want to raise rates anymore, they say it will, you just need to wait. It's all coming down the pipeline. But of course, it would have been nice for the Bank of England to see a bit more evidence of things slowing down, things like the labour market unwinding. And actually, this economy seems to be re-accelerating, not decelerating. So, even with that understanding that the economy operates with a lag, I guess underlying momentum in the economy and in the labour market was stronger than perhaps anybody gave it credit for.
Now, the market is currently pricing in a peak, the terminal rate, if you like, of between 4.75% to 5%. I mean, would it be your assumption that we'd get at least another quarter point after today?
Yeah, so another one on the 22nd of June, another quarter point. I don't think that's as nailed on as today's. The Bank of England will have 2 inflation prints and 2 labour market prints between its May meeting and its June meeting. So it's possible that everything looks very different by the 22nd of June. But the base case is that things will look a little better, but still worrying enough for them to hike one more time. So our view is one more to 4.75 and then done. But risks, I guess, in both directions to that.
Absolutely. Liz, busy day for you. We do appreciate you speaking to us today. Thank you.
Thank you.
Now, First Group, which runs the TransPennine Express rail service in northern England and into Scotland, is not having its contract renewed. The Department for Transport has blamed months of continuous cancellations on its services. Well, joining me now is our political correspondent, Tamara Cohen at Westminster. I mean, this has caused a lot of unhappiness in northern England, the performance of this franchise.
It has. It will come as no surprise to passengers who take it regularly that there have been, in the words of the Transport Secretary this morning, continuous cancellations taking a toll on passengers and on businesses. In January and February this year, as many as 1 in 4 services on the line were cancelled. And thus comes this announcement this morning, threatened by ministers over the last few months, that the line will be taken away from First Group, which has operated it in various guises since 2004 and basically brought under government control, run by an operator of last resort. Now, over the last few years, we've seen a few rail franchises brought under government control when their contracts have ended. South Eastern for the last 2 years, Northern Rail and also LNER. So although the government say this is temporary and they hope it will put back in private hands, the evidence so far is that rail franchises are being taken in-house and then kept there. Now, Labour say they've been calling for this for a while. Why didn't they do it earlier? The Labour Mayor of West Yorkshire, Tracy Brabin, has said that too often people are crammed in like cattle and that it's time for a change on that line. Now, the government say that this is not a silver bullet, not least because the ongoing dispute with the train drivers union, ASLEF, and their refusal to do overtime has certainly not helped matters. But at a time when the government say they're committed to levelling up and connecting northern cities, they'll be hoping that under this new arrangement, the experience for passengers improves.
Thanks, Tamara. And I can tell you that shares of First Group are currently off by some 5% on that news this morning. Some other business news stories for you now. And the aircraft engine maker Rolls-Royce said today it was on course to hit its targets for the year as the aviation sector continues to recover post-pandemic. Well, Rolls, which is paid for the number of hours that its engines are airborne, said that during the first 4 months of the year, flying hours were at 83% of 2019 levels and on track for the 80 to 90% range that it's predicting for the full year. Rolls also flagged new contract wins, including 68 engines for Air India and another contract to supply engines for the US Navy's Constellation-class frigate programme. Vodafone said this morning that it is entering a strategic relationship agreement with its biggest single shareholder, Abu Dhabi-based Emirates Telecommunications Group. The pair will explore jointly offering cross-border digital services and solutions, including fixed and mobile connectivity to multinational customers and public sector organisations. They will also look into adopting joint procurement. Well, as part of the arrangement, the chief executive of Emirates Telecommunications Group, which currently owns 14.6% of Vodafone, will join the British company's board. ITV said this morning that its advertising sales during the first 3 months of the year were down 10% on the same period a year ago. The free-to-air broadcaster said this was as expected and was better than the wider TV advertising market. It meant as a whole that ITV's sales during the period fell by 7% to £776 million. But Dame Carolyn McCall, ITV's chief executive, said the company's rebranded streaming platform ITVX was performing strongly, with digital revenues up 29% and total streaming hours up 49% on the same period a year ago. The shares have, however, fallen by just over 4% on that update. Now, late payments are costing European businesses €275 billion a year, according to Intrum, the Swedish credit management company. It carried out a study of more than 10,000 companies across 29 European countries and found that, on average, businesses spend 29% of their working year chasing overdue payments. Well, these payments take an average of 74 days to resolve. Joining me now is the President and Chief Executive of Intrum, Andrés Rubio. Andrés, very good to see you this morning. We talk about late payments in this country a lot. The situation's actually even worse in even big economies like France, Germany and Spain.
Well, yeah, I mean, and good morning and thank you for having me. Unfortunately, this report proves out exactly what you're saying, which is the real economy is undergoing significant challenges that manifest themselves in late payments. And although, yes, you see the effect in Germany, France, and Spain, you're seeing in this report, similar to the consumer report we put out a few months ago when I was last on the program, an effect in the larger economies greater than the smaller economies. And frankly, the UK is the most affected. But late payments, it's important to note, Ian, that late payments are a byproduct of the root causes of what's ailing enterprises. Enterprises are undergoing energy inflation. The UK is the most effective. Wage inflation, 9 out of 10 enterprises are experiencing extraordinary wage demand. So you have operating cost increasing. Obviously, you cover it very well. There's interest rate increases. So financial and operating costs are increasing. Enterprises are finding it very difficult to recoup that in the pricing of their products, so profits are declining. The consensus is that this is not going away also. 3 out of 4 UK firms and a slightly lower percentage across all of Europe believe that this will last for more than a year. That's putting enterprises on their back foot, not on their front foot, and putting them more in a defensive posture. As a consequence, they're scaling back growth plans, they're limiting indebtedness, and they're focusing on costs and efficiencies. And then that manifests itself in dealing with late payments when firms look at their working capital in order to reduce their investments and improve their cash flow. And that's a significant drag with the 275 billion figure and the 74-day figure that you cited being the equivalent, for example, just to put it in context for your viewers, of the GDP of Portugal or Finland, or the entire revenue base of Toyota or Google. So it's a very significant headwind for the economy, and it's also a cycle.
Vast sum of money indeed, yes. So now, do approaches to dispute resolution over late payments vary much from country to country across Europe?
It does. And unfortunately, most enterprises, particularly small and medium-sized enterprises, are not equipped to fully deal with it. They don't have the processes and the financial controls. They don't have the technologies. They generally, 50 to 60% of the firms outsource it to a lawyer. 20 to 25% do it themselves. 10% don't even deal with it. But it's also a very delicate situation because you're dealing with your clients. And obviously, you have a complete legal right to be paid what you're owed. But at the same time, this is a client with whom you want to continue doing business for the most part. So lots of firms take a different approach. And I think what we need, and I'm not to promote my own company, but we need to actually look for professional companies like ourselves who deal with this on a daily basis. We do this across 24 countries. We have 10,000 people dealing with this every single day. Outsourcing to those type of firms would allow a communication and an intermediary to resolve these things and for them to continue their commercial relationship.
Do you see any particular business sectors where late payments are more of an issue than in others, or is it pretty widespread across the board?
There are differences, although the differences are not as wide as you would think. Obviously, the more capital intensive, banking, finance, industrial companies, those companies where there's more capital involved in the business, there's more payments moving around, those are worse. The public sector, interestingly enough, is also not great at paying their payments. But ultimately, at the other end of the spectrum, you have companies that have a little bit more of an economic tailwind and also less capital intensity, hospitality, travel, leisure, et cetera, doing relatively better, but it's affected across the board. Ian.
All right, Andrés, we've got to leave it there, I'm afraid. Good to see you again this morning. Thank you.
Thank you very much.
Now, France remains the top destination in Europe for foreign direct investment, with Britain in second place and Germany in third. Well, those are the findings of the Europe Attractiveness Report published this morning by the accounting and business services giant EY, which reveals that the 3 countries account for half of all inward investment projects in Europe. But it also reports that foreign direct investment into Europe stalled last year. It was up just 1% on 2021 and remained 7% lower than in 2019 before the pandemic struck. Well, joining me now is Julie Lynn Teagland. She's EY's area managing partner for Europe, the Middle East, India and Africa. Julie, good to see you this morning. Why has investment stalled, do you think?
I think we've been expecting a huge bounce back on the back of COVID-19. We didn't see that happen. And let's be honest, the world around us has changed quite a bit. Ian, we've got a war in Ukraine going on. We have an energy crisis. Food prices are up. Inflation, as you've been reporting all morning, is up. It's an extremely difficult environment across Europe right now.
Looking at a country-by-country basis, I mean, it seems to me that France is pulling away from the UK and Germany. Why is France doing relatively well?
France has invested over the past years in significant reforms, increasing the flexibility of their own labor markets, improving their tax positioning across the space, and that's made them a much more business-friendly environment on a relative scale. So France has done really well, and you see the impact of that coming through in FDI, not just this year, but also in the previous 3.
What I did think was quite interesting, though, was that although France is attracting more individual projects than the UK, more jobs are created per project here in the UK than elsewhere.
Absolutely. And Ian, I think one thing that we should recognize, the UK has really been the leader when it comes to creating R&D jobs. Now, those are really high value creation in terms of FDI investment, attracting some really interesting industries. They've been leading the way on that, and that's important to remember.
But we can't get away from Brexit. I mean, you're quite clear in your report that Brexit is actually hurting the UK's position.
I do think that Brexit has had an impact. I don't think it's been incredibly positive. It's just in light of the volatility and the changes we see across the world, and I mentioned a few of those a couple of seconds ago, Brexit just adds to the complexity when we're looking for an environment of free trade.
Do you think that's a temporary phenomenon? Do you think that the UK eventually, as it starts to sort of pull different levers from the EU, can recover that situation?
I think as the UK really focuses on bettering their trade relationship, and some of the accession to the Trans-Pacific trade agreement are an indication of that, I do think there's an opportunity for the UK to smooth the waves and create better trade patterns, reducing those barriers and the bureaucracy that comes in between.
Now, one of the other little nuggets that jumped out at me is which countries are doing particularly well in terms of attracting investment. I mean, the yellow leader jersey here goes to Romania. Massive increase in investment projects.
Absolutely. And Ian, I think it's been a real phenomenon. You look at Southern Europe, I'm going to say Italy, Turkey, Romania, and you really see that supply chains across Europe are on the move. They are completely being redesigned, taking advantage of wage arbitrage, but equally taking advantage of really skilled labor across an umbrella of European consistency of law. That's attracted massive amounts of investment. Now, that's a good thing in my view. On the back of COVID, we expected a lot of supply chains to change. A lot more nearshoring and concepts like friendshoring have been invented. We see those impacts across Europe. I don't think that's the end of this journey. I think you're going to see more of that. And that's why I think you talk about what we just mentioned, UK being high on the scale of strong R&D, Southern Europe being high on the scale in terms of supply chain moving, take advantage of that wage arbitrage and skilled labor.
All right, Julie, we have to leave it there. It's a fascinating report. Thanks for discussing it with me today.
Thank you very much, Ian.
Well, a relief rally on Wall Street last night following another decline in US inflation was followed by a dull session overnight in the Asia-Pacific region. Most of the markets were largely flat amid concerns over deflationary pressures in China and a mixed bag of corporate updates from Japanese companies. Well, in Europe, stocks have rallied after a two-day losing streak. Here's the current picture. All of the main continental European indices are in positive territory right now. Again, it's a busy results day. Talking points include ING, the biggest bank in the Netherlands. It's ahead by some 4% in Amsterdam after its quarterly results came in better than expected. But the German drugs and biotech giant Bayer, its shares are off nearly 7% in Frankfurt, and that followed a downbeat trading update. Here in London, well, the FTSE 100 is also in positive territory. It's more or less flat, to be honest, looking at that. Consumer and healthcare stocks leading the way. Among the leading blue chip gainers right now is Haleon. That's the owner of Sensodyne toothpaste. The shares there nearly 2% to the good on positive broker comment. Another blue chip going higher this morning is the aerospace engineer Melrose. The shares up another 1.25% following yesterday's well-received trading update. On the downside, Airtel Africa, whose chief executive you might recall we had on the programme recently, well, its shares are down 3.5%. It's got results out this morning. As ever at this time of year, a number of stocks have gone ex-dividend. In other words, they're trading for the first time without rights to the latest payout. Those going ex-div today include HSBC, BP and Tesco. All of those adjusting lower to reflect the fact they've gone XD today. Outside the FTSE, well, First Group, look at that. Mentioned them a little earlier in the programme, off 5.25% after it lost the rights to operate the TransPennine Express rail contract, while ASOS off another 4.5% after yesterday's rise in losses. It fell by 20% yesterday. On the foreign exchange markets, well, pretty much unchanged for the pound. That's off a third of 1% against the US dollar ahead of this lunchtime's rate decision. It's up nearly a sixth of 1%, though, against the euro, the single currency off half of 1% almost against the greenback. As for the oil price, well, that has clawed back some of yesterday's losses on news of a sharper than expected drop in US gasoline inventories. A barrel of Brent crude will currently set you back $77.09 a barrel. That is up 0.9%. Joining me now is the head of investment at Interactive Investor, Victoria Scholar. Victoria, good to see you this morning. Let's start with some news that we got overnight in the US. We had quarterly results from Disney.
Yeah, that's right. And we saw that it largely met expectations on the top and bottom line, but its Disney Plus subscriber figure fell by 4 million, missing expectations, which is why the stock was off by almost 5% after hours. I think investors largely shrugged off a stronger performance in its theme parks, where we saw a jump in revenue for that division to $7.7 billion. But, last year was very tough for Disney, caught up in the so-called tech wreck when the whole of the US tech sector came under heavy selling pressure. But we have seen Disney enjoy a significant recovery. It's been doing a restructuring, including slashing 7,000 jobs. There's the return of Bob Iger as well as CEO after retiring less than a year ago. And of course, there's been that broader rebound in technology as well.
A lot of company news on this side of the Atlantic to grapple with this morning, Victoria. One that caught your eye was Wood Group.
Yes, that's right. Wood Group has been in focus lately because of this potential takeover from Apollo, the US private equity giant. But it reported first quarter revenues of $1.45 billion in the first quarter, rising year on year. But its order book actually slowed, and it's kept its full year outlook unchanged and highlighted the uncertain macroeconomic outlook. But like I say, the real focus for this company is as investors await this key deadline before which Apollo must decide whether or not it wants to make a formal offer for Wood Group. Apollo has also set its sights on THG, and we've seen a number of private equity firms setting their eyes on UK companies lately because of that discount in terms of valuations, with the FTSE underperforming the DAX or the CAC over the last 5 years, and also because of the weakness in sterling, which again makes UK targets more attractive. But, we've seen sterling start to come back. It's back up at a 1-year high. So perhaps the time is ticking and we might see more of these PE offers come to the table quite soon.
Interesting. What about Rolls-Royce? I mean, a fairly reassuring trading update this morning, but it didn't really move the dial so far as the share price was concerned. I mean, is that because it's had a good run already, this stock?
Yeah, it's one of the best performing stocks on the FTSE 100 lately. It reaffirmed its guidance for the full year, but I think there's some disappointment that it didn't actually upgrade that guidance, given that there's been so much enthusiasm towards this stock lately with the new CEO and the rebound in international travel post-pandemic. This stock is up about 50% so far this year. Back some of those gains today. It's in the midst of a major transformation program. And although we have seen this major rally so far this year, the stock is still trading at less than half of its market cap back in 2018 before the pandemic. So there could be more upside, or at least there's a long way to go to try to reclaim those highs.
That is fascinating. I hadn't realised that. Victoria, good to see you this morning. Thank you. You always learn something on this programme, I hope. Still to come here on Ian King Live, I'm going to be speaking to the Chief Executive of Grainger, the UK's largest listed residential landlord. It's just published its half-year results. Don't go away. pound has rallied. Moderation, interest rates peaking
up at 6%.
The highest for 14 years.
Will that be the peak? Will it be a little bit lower?
It's closer to a potential crash.
So many words, so many meanings. But what do they mean for you and your finances? Stay up to date on Sky News.
I'm Adam Parsons. I'm Sky's Europe correspondent based here in Brussels. Cobbles have been pulled up out and are being used as missiles to hurl at these police. Made by people who dare to challenge. Nice to see you again, Mr. Barnier. Why? Meeting you. Fishing does have the potential to stymie an enormous economic deal. We take you to the heart of stories that shape our world. What strikes you when you come to this glacier is not just the way in which the environment is changing, but the speed at which those changes are happening.
Welcome back. Now, the number of homes available to rent in the UK has fallen by a third over the past 18 months, according to data recently published by the property website Zoopla. One company in the forefront of attempts to remedy that is Grainger, which is the UK's largest listed residential landlord. This morning, the company, which owns and manages more than 9,000 rental homes across the UK, announced a 2% rise in adjusted earnings to £47.1 million for the 6 months to the end of March. Headline pre-tax profits, however, fell by 94% to £5.7 million due to valuation movements. Well, joining me now, I'm very pleased to say, is Helen Gordon. She's the Chief Executive of Grainger. Helen, welcome to you. A very quick word, I don't want to get too bogged down in the numbers, but what informed these valuation movements?
Well, we have seen an outward yield movement, and that's really come from a view on rising interest rates. Having said that, we offset that by strong rental growth, and that's new lettings and also rental growth, which we at Grainger normally align to wage inflation. So we've seen 6.8% rental growth, 12% rental growth overall, and that's very much aligned with wage inflation at the moment. So a good rental story, but obviously interest rates affecting valuations.
Yeah, you kind of preempted my next question. I was going to ask you what the approach was to rent increases. I mean, does it vary much from location to location as well, or is it a flat increase linked to wage inflation, as you say?
Well, Grainger own and manage all our own properties, and we have a really strong customer relationship. So we understand customers' affordability. Our main customer demographic is in that 25 to 34 age group. They're spending about 29% of their income on rent. And so we're very much aligning it to their wage inflation. So we've seen good wage inflation coming through, and we've been aligning our rents towards that. So it's still very affordable for our customers, and we concentrate on that mid-market approach to renting.
What's the duration of a typical tenancy for you these days?
So we concentrate on customer retention, and our average tenant stays with us for just under 3 years. And when you think it's in that 25 to 34 age group, that's actually quite a good statistic.
Now, I think you're targeting something like 1,640 new homes this year. What sort of progress have you made to date?
Yeah, we've got 7 new large openings later this year, and that's going to really boost our income in 2024. But we've actually got a pipeline of 6,000 new homes. So it's, very, very strong pipeline when you compare it to our existing portfolio. And that pipeline is fully funded. That we've got around 3,500 homes on site at the moment. So that's, a really strong pipeline to come.
What are you seeing right now in terms of build costs?
Everything that's on site is our construction costs are fixed. That's our business model. But we are seeing construction inflation for our new schemes that are coming through. That is actually now softening.
Right, interesting. And what about planning permission? I mean, this is obviously a constant bugbear for the industry. Is that going to affect the timing of you delivering on the pipeline that you're aiming for?
We've been very successful at planning consents. I think, London, which is seen as being the hardest city, we've achieved nearly 2,000 planning consents, 2,000 homes in the last couple of years. But planning consents throughout the whole of the UK at their lowest level ever on record. So you're right to point out that planning is a challenge, but we tend to be developing in urban locations which are probably less sensitive than some of the sort of greenfield and suburban locations.
Now, build to rent has become quite a hot area in recent years. The likes of M&G and Legal & General are moving into this patch. Has that made life more difficult for you in terms of land acquisition?
No, our acquisition strategy is strong. A question I often get asked is, are people leaving the sector? And of course, it's proved incredibly resilient. And so there is a lot of appetite, not just from institutional players, but also sovereign wealth funds to own in the long term rented homes in the UK. And I think that's a really good thing for the UK economy, because having a good, well-financed private rented sector will see the end of poor, bad landlords. And I think that's good for the UK economy. It's good for mobility. It's good for levelling up. It's good for so many things. So I actually welcome the fact that we've got lots of people seeing this as a really good place to invest.
Obviously, rents are rising appreciably across the economy as a whole. People like Sadiq Khan, the London mayor, are talking about rent controls. What would that mean for your business?
Well, I think that this government, and I think also across all political parties, they know that the real problem on renting is the supply. And you started this piece by talking about the fall in supply of rented homes. So one of the things I would say is we've seen in Scotland that where they've introduced rent caps, it has actually led to a fall off in supply, a rising in rent, and a fall off of investment. So for me, I think that we across all of the mayors, they don't have the ability to bring it in, and I think it would be very wise for this government and any subsequent government to think about what that will do to the supply side as well. I think also it behoves us to be very responsible as landlords in terms of how we grow our rents as well.
Well, you couldn't have been more clear on that, Helen. We haven't had you on the programme for a while. It's good to see you again. Thanks for joining me.
Nice to see you, Ian.
Still to come here on Ian King Live. Digital services provider Noventiq is the latest company looking to switch from London to the US. I'll be asking its chief executive why it's shifting its focus. Welcome back. Bit of breaking news to bring you, which is that two Metropolitan Police Service officers have been dismissed without notice for punching and kicking a 14-year-old boy during his arrest before lying about the incident in their statements immediately afterwards. A hearing of the Independent Office for Police Conduct heard that police constables Alexei Zaleski and Connor Ryan were accused of using excessive force on the child in North London in April 2021. More on that story throughout the morning here on Sky News as we get it. Now, we've talked a lot on this programme recently about the falling popularity of the London stock market. CRH, the owner of Tarmac, is shifting its main listing from London to New York, and Flutter Entertainment, the owner of Paddy Power and Betfair, is thinking of doing likewise. Meanwhile, the chip designer Arm Holdings recently decided against a secondary listing in London, despite the government's pleas. Well, another company that's upping sticks is Noventiq. It's a global provider of digital transformation and cybersecurity solutions and services. It's been listed in London for 18 months, but it's now looking to relocate to NASDAQ. Well, joining me now to talk about this is Noventiq's Chief Executive, Hervé Tessler. Hervé, tell me why you're going.
Good morning, Jan. And first, thank you for having Noventiq today. It's not, Jan, it's not a matter of, London versus NASDAQ or London versus New York. In the case of Noventiq, we had a successful IPO in London at the London Stock Exchange in 2021. Since then, we've been doing a lot of things to improve the business, to keep growing, to deliver value. And we've been also looking at options to make sure that we keep delivering that value to all of our stakeholders. And we got to a point when working with Corner Growth was the most obvious way to move forward, keep accelerating our growth and bringing value to our customers in all the markets where we operate. So that's how we decided to make that move.
Your share price is off something like 75% since the IPO. Why do you think London investors haven't bought into the story?
I think there's a number of things. One, we've been through a year of major activities. We demerged from our Russian entity. We sold our Russian business. We rebranded the company. But basically what we want to achieve is get the right valuation of the company that we believe is undervalued today. And we want to gain access to tech-savvy investors that we believe are very, very present at the NASDAQ, because it's really a tech exchange, to gain access to capital, to, again, keep investing for the growth of our business. We're growing, Jan, on a kind of a balance, with a balanced model of organic investments and inorganic investments. In the last 12 months, we acquired 7 new companies across the countries where we operate in the emerging markets, and we want to just keep doing that.
You just used the phrase tech-savvy investors, and you've put your finger on what a lot of people think is a critical issue here, which is that investors in the UK don't really get tech.
Well, I'm not gonna make that comment. I'm not gonna build on what you just said. But what I think is it's a matter of scale, and it's a matter of, as you know, the NASDAQ is a pure technology play, right? So by design, by definition, the players are tech-savvy. And I'm not saying there's no tech-savvy investors in the UK. By the way, our IPO was very successful, proving that a number of investors here were keen to go and support the growth of a business like Noventiq.
Now, your market cap, I think, and fairly recently has been around $270 million. By how much would you hope it might rise when you switch to NASDAQ?
Well, the model and what we communicated last week when we announced the business combination with Corner Growth is a valuation around $800 million at NASDAQ.
Now, you mentioned you've just issued a trading update. You are still seeing in growth generally across the piece. Are there any business segments where it's a little softer demand?
No, I think, obviously, the world is pretty bumpy. I think what is very specific at Noventiq, given our history of operating in the high-growth emerging markets, we have a very specific operating model, which is very decentralized. So we have a lot of extremely talented people on the ground that are connected to the different markets. And so we have a way to adapt to the major market shifts, but also to the major market opportunities. And we strongly believe that in these markets, despite the global geopolitical environment and economic environment, technology, IT services, digital transformation, cybersecurity, everything that's coming with AI supported, pushed by the likes of Microsoft, because we're also a very strategic partner, global partner of Microsoft, but also Google, Amazon Web Services, Citrix, VMware, you name them. All of them are counting on a company like Noventiq to have that local relevance, that local market connection, so that we can help these customers in these emerging economies to go through their digital transformation journey.
OK, Hervé, we have to leave it there, I'm afraid. Good to talk to you this morning. Thank you.
Thank you very much. Thank you, Jan. Thank you. Bye.
Now we're going to stay with this theme because SoftBank, the Japanese tech investor that owns the chip designer Arm Holdings, has reported a net loss overnight of $7.18 billion for the year to the end of March, while it's written down the value of its flagship Vision Fund portfolio for the fifth consecutive quarter to reflect a decline in tech valuations. Well, the fund's recent performance helps explain why SoftBank is floating Arm, but its decision to opt for a New York listing and not London has prompted a good deal of soul-searching about the UK market's attractiveness as a destination for international businesses. But some would argue the damage was done back in 2016 when Theresa May's government, desperate to show the UK was still open for business after the Brexit vote, nodded through the takeover by SoftBank in the first place. Well, those events and the birth of the company have been chronicled in a new book, The Everything Blueprint, published today. And joining me now is the author, James Ashton. He's also chief executive of the Quoted Companies Alliance. James, good to see you this morning. Let's get to the heart of it. Should this takeover have been allowed in the first place?
I mean, you know, we make so much, Ian, of the UK being an open market, and there really weren't the controls in 2016 to stop it, I think. And actually, in the days when it happened, I mean, that famous tweet from Philip Hammond, "This is a wonderful deal for Britain," he'd been in office 6 days. You know, Theresa May, I don't think, had unpacked yet. So it was, we were in no position to say no at that stage. And what's interesting in writing about that then and writing about the events of the last couple of months is that the sale of Arm then was seen as a validation of the UK. And had Arm come back now, that was also validation of the UK. Yeah. So it's interesting how this big company has become such a symbol, if you like, such a crown jewel.
It really has. I mean, the UK is now taking a more interventionist approach towards takeovers on issues like national security. Do you think the takeover will be waved through today under today's circumstances?
It's difficult because I think there is. I don't think we know where we stand yet with semiconductors. We are waiting for we're waiting for a long time for a semiconductor strategy as to what the UK thinks. There are things you can do, around national interest, of course. Had it been a US company then and now, it certainly wouldn't have happened. Today, I think. Well, interesting, as you see from your last your guest, sadly, the companies are leaving in any case.
I mean, you make the point in the book, though, that it had to be shareholders ultimately that agreed to it, and they were happy to sell. I mean, there was obviously a big shareholder who was very unhappy at it, but people waved it through. The investors took their money.
They did. I mean, they waved it through in astonishing fashion. I mean, it was, I think I put in the book, 64 days from the first approach, the lunch, on the waterside in Turkey, to the deal completing. And really, really senior city people had never seen anything like it, the speed with which it went through.
How do you think Arm has fared under SoftBank's ownership? I
think the thing is, and we see the figures this morning, and clearly this is the time in the cycle when they need to, they're fattening up for market again, so they have to look good. I think the thing is, Arm is such a long-term business. If you plan IP today, you're starting to get revenues probably 5 years from now from the end customers. I think we can say today is that the ownership under SoftBank has not been a failure. I think we need to look a little longer to see whether it's been a great success. Certainly the revenues are good. Roughly, the business is twice as big as it was when it was taken over. In the year they've just posted, there's about 6% top-line growth, which is pretty good, particularly when you think this is a company that's been wedded to smartphones for many years. And smartphones have had a terrible year. There's some smartphone decline. So that's pretty good. I mean, profitability, you can't really tell yet. There's an awful lot they've put aside for staff compensation and so on. But I'm sure we'll see more as we get towards September.
As a standalone business, once again, will there be things that it is able to do that it couldn't do as part of SoftBank?
I'm not sure. I mean, I think there was all this talk when it was taken over that it would work across the whole portfolio of SoftBank's investments, and really it was quite a discrete business within that. Had it gone to Nvidia, that was a real that would have been a real integration piece, if you like. But I think no, I think it could work. It could work either way. What it's had the benefit of over the last 7 years, you know, we talk about SoftBank has invested in Arm. Well, actually, SoftBank's money went to Arm's shareholders 7 years ago. The best thing that SoftBank has done for Arm is not take a dividend, which clearly, if you come to market, this is always an issue with the investors, whether New York or London. What is the dividend? When do you pay the dividend? What's the yield and so on?
Now, Arm was born, of course, in Cambridge. It has several thousand employees there to this day. Does it still retain that sort of Cambridgeness to its culture?
I think the great strength of Arm was that, and the success of Arm was it thought internationally from day one. It had no money, no patents. It didn't have the customers. The first thing the management did was get on the plane to Asia again and again. If you like, the locus of the company has drifted to the west coast of the States over the years. There's more management there now than in the UK. There's 2,800 people in Cambridge. You know, I think, you know, if you were only a UK company, you wouldn't have had the success you've had. But I think, you know, we can be grateful, and we can build on 2,800, you know, highly skilled, highly paid jobs in Cambridge.
Absolutely. James, good to see you this morning. Thank you. Bit of breaking news to bring you. A BBC Conflicts of Interest review has found that there were no concerns about Richard Sharp's integrity while he was BBC chairman. It was commissioned after Mr Sharp was embroiled in a cronyism row involving Boris Johnson, which ultimately led to his resignation as BBC chairman 2 weeks ago. More on that as we get it. Still to come here on Ian King Live, the chief executive of the British Basketball League on plans to go global. Stay with us. Has rallied, moderation, interest rates peaking.
I'm up at 6%.
The highest for 14 years.
Will that be the peak? Will it be a little bit lower?
It's closer to a potential crash.
So many words, so many meanings. But what do they mean for you and your finances? Stay up to date on Sky News.
I'm Adam Parsons. I'm Sky's Europe correspondent based here in Brussels. Helicopters have been pulled up out and are being used as missiles to hurl at these police. Made by people who dare to challenge. Nice to see you again, Mr. Barnier. Why? Meeting you. Fishing does have the potential to stymie an enormous economic deal. We take you to the heart of stories that shape our world. What strikes you when you come to this glacier is not just the way in which the environment is changing, but the speed at which those changes are happening.
Global insight, made local. Invest in your future. Sky News Financial Reports, sponsored by Interactive Investor. Invest in your future. Sky News Financial Reports sponsored by Interactive Investor.
Welcome back. Now, this Sunday, more than 16,500 fans will fill the O2 in London to watch the playoff finals in the Men and Women's British Basketball League as the London Lions take on the Leicester Riders. Basketball in the UK is relatively small beer compared with the super-rich NBA across the Atlantic, but the British Basketball League has just brought in a new chief executive at the end of last year to try and change all that. Aaron Radin previously worked at the NBA, Meta and Disney. Now he has ambitious plans to turn British basketball into a global player. And Aaron joins me now. Welcome to you. I mean, the UK has some very strong team sport traditions, football, rugby, cricket. Can basketball ever really hope to compete with them?
So I think I look at this as not just a sports competitive, but really an entertainment competitive landscape. And even just offline, we were talking about Disney before. And so when we think about basketball, we're thinking about presenting an entertainment product that is going to drive attention. And so in that respect, we're competing, of course, with football and rugby and other sports, but we're also competing with Netflix and TikTok and Facebook and where other people spend their attention. And so our goal is really to produce, a very entertaining and compelling product that brings joy to its fans and creates value for our marketing partners as a result of doing so. I think from a target audience standpoint, the thing that's particularly encouraging about where we are today is that the core of our audience is 13 to 34-year-olds, which is really in the media landscape the hardest audience to reach. So I think that we have a very strong foundational basis to build a compelling business upon where we can drive value for partners.
Is the aim to drive participation as well as audiences?
I think it's a little bit of both. So I think it starts with the experience of going to a game in person. We want to have an amazing night out for individuals, for families, that those people become effectively our brand ambassadors because of what a great time they've had at the event. At the same time, we're really focused on producing content product. That's everything from the broadcast to all sorts of digital content and distribution across multiple platforms. I think a key piece of that is, particularly in the sports landscape, it's very easy to produce highlights. There's automated tools to do that. You any type of platform, you see all sorts of different highlights. What we want, of course, you need to do that. That's sort of table stakes. In addition to that, we want to do storytelling. We want we want people to understand and begin to create an emotive connection with our players, our teams, even league executives, because that's really what drives engagement. And if you look at sort of the sports landscape, particularly over the last couple of years, those that have done that well have really seen elevation of their performance. So F1 with Drive to Survive, Welcome to Wrexham is another example where you've seen the level of engagement increase dramatically as a result of creating a connection with the personalities that are involved in those sports.
What about grassroots participation?
Yeah, so
are you going to have to invest in more courts and things?
So each of our clubs run grassroots programs. It's an incredibly important driver. In fact, my own personal history, I coached and ran a grassroots organization in Brooklyn, New York for many, many years. And so enabling kids to have the ability not only to have facility to play, I've noticed that it rains a lot here in this country. So having indoor facilities is really important, and helping to provide the funding for that, but also the coaching and the skill development. I think typically in a football system, you have these academies, and they do skill development. In basketball, it's a little bit different. You can have that, but also a lot of the best talent, particularly the GB talent, will go over to the United States to go and play in college basketball. And then, what we're hoping and what we're starting to see is that a lot of those people are coming back to play here. I think a huge part of our eventual success will be in tracing the arc of Team GB, both on the men's and women's side, and hopefully elevating that performance to a world-class level.
Well, you've got your work cut out there. I mean, the NBA is a massive draw. I mean, a young basketball player from this country can earn a life-changing sum of money going there, which they probably can't here.
Yes, we're not competing. So I think from a talent competitive perspective, that is the pinnacle of the sport. And it's both from a competitive standpoint, but also from a compensation standpoint. We're not going to be anytime soon, competing with that type of attractiveness from a competitive standpoint. At the same time, there are 450 people who play in the NBA. There's probably 2,500 people probably good enough to play in the NBA. It's just a function of circumstance. And so, from our standpoint, we're looking to build sort of the next best option in terms of where those players can actually hone their craft and demonstrate.
Got to leave it there. Good to see you. Thanks.
Thank you.
That's it from me. I'm back at 10 o'clock tomorrow morning. Do stay tuned, though. Up next, it's Anna Jones with all the build-up to the Bank of England rates decision at midday. See you tomorrow. Cheerio.